Welcome back to the SafeSimpleSound podcast. We are so glad you've joined us today. Here, we believe that financial planning shouldn't be a source of anxiety or a black box of confusion. Instead, we believe in a constitutional approach, one that creates both and solutions for the contradictions families and business owners face every day. In today's episode, we are exploring a fundamental question that sits at the very bedrock of financial security. Is your financial safety net actually tied? This is the same topic we recently explored in our written commentary, and we're diving deeper today because the insight is critical for anyone who owns an insurance policy. Whether you are a business owner protecting a key partner or a head of household protecting your family's future, this episode will give you the ability to verify that your protection is real, legally binding, and ready to hold up when it matters most. Let's start with a feeling we all know. Buying an insurance policy often feels like a simple transaction, doesn't it? You go online or meet with an agent, you agree to a price, you pay a premium, and you receive a PDF file in your inbox or a thick packet in the mail. You file it away and you sigh with relief. You think, okay, that's done. I'm covered. But here's the challenge we observe in our practice. In the eyes of the law, you haven't just bought a product like a toaster or a car. You have entered into a very specific, highly regulated type of legal relationship. The anxiety that many of the families we serve face, often subconsciously, is the gnawing fear that when they finally have to pull the ripcord, the parachute won't open. They worry about the fine print. They worry about the technicality that lets the insurance company off the hook. This creates a dangerous contradiction. On one hand, we buy insurance specifically for security and peace of mind. But on the other hand, the complexity of the contracts often creates more anxiety. We are trying to buy safety, but we end up buying a mystery. At SafeSimpleSound, we resolve this through what we call safe foundation first planning. We don't view legal elements as boring compliance boxes to be checked and forgotten. We view them as the knots that tie your safety net together. If one knot is loose, the net fails. But if you understand the knots, if you can inspect them yourself, that anxiety vanishes. Today, we are going to walk through the constitutional basics of insurance contracts. We're going to move past the transactional illusion, the idea that payment equals coverage, and look at the actual legal architecture that protects your family. By the end of this episode, you won't just hope you're protected, you'll have the tools to know you're protected. And that is the essence of the SafeSimpleSound way. Let's establish our foundation. To build a safe financial home, we have to inspect the materials we are building with. Many people operate under what our team calls the myth of the standard policy. This is the assumption that because money left your bank account, a valid contract exists. But in our S3 framework analysis, we know that for an insurance contract to be legally enforceable in a court of law, it must meet specific constitutional requirements. A policy issued without these elements isn't a safety net. Legally speaking, it's just a piece of paper with numbers on it. So, let's look at the three primary knots that make a contract valid. These are terms that every first-year law student learns, but tragically, very few policyholders are ever taught how these concepts protect their own families. The first knot is offer and acceptance. This sounds simple, right? One person offers, the other accepts. But in the insurance world, this is where the meeting of the minds must happen. Usually, you are the one making the offer. When you fill out an application and write that first check for the premium, you are making an offer to the insurance company. You are saying, I offer to pay this amount if you promise to pay this benefit. The insurer then accepts your offer by issuing the policy exactly as applied for. If that happens, offer then acceptance, the knot is tied. However, here's the trap we often see in our practice. Sometimes, the insurer reviews your medical history and decides they can't offer you the super preferred rate you applied for. Instead, they issue the policy at a standard rate, which costs a little more. Legally, they have not accepted your offer. They have rejected your offer and made a counteroffer. Why does this matter? Because a counteroffer requires you to accept it again. Usually, this means signing an amendment form and paying the difference in premium. If you receive that policy in the mail, look at the higher price and just file it away thinking, I'll deal with the extra payment later. The knot is not tied. There is no contract. Until you formally accept the counteroffer, you are floating without a safety net. The second knot is consideration. In legal terms, a contract isn't valid unless something of value is exchanged. This is called consideration. For the insurance company, their consideration is their promise to pay a future claim. But what is your consideration? Most people think it's just the money, the premium check. But from a safe, simple, sound perspective, we know it's actually two things: money and truth. Your consideration includes your payment, yes, but it predominantly relies on the truthful statements made in your application. This is vital to understand. If you accidentally leave out a major medical event, or if your check for the first premium bounces, the consideration is incomplete. There is a constitutional maxim in contract law: no consideration, no contract. This is why we emphasize the safe aspect of our framework. Honesty isn't just a moral virtue, it is a structural necessity for your financial safety net. If the foundation is built on partial truths, the net cannot hold weight. The third knot is legal competence. A safety net is only as strong as the anchors holding it to the wall. In legal terms, both parties, the insurance company and the policy owner, must be competent to enter the contract. This sounds obvious. You might be thinking, well, of course I'm competent. But this is a frequent point of failure we observe in business planning and complex family estates. We have to ask, who is actually signing the paper? If a grandfather names his 12-year-old grandson as the owner of a policy to get it out of his estate, that contract is voidable. A minor lacks the legal competence to enter a binding contract. If a corporate officer signs an application for a key person policy, but the corporate resolution didn't actually authorize that specific officer to spend company money, the competence is in question. In our practice, drawing from our S3 methodology, we see this most often with old trusts. A family might sign as trustee, but the trust was never actually funded or finalized by the attorney. If the entity doesn't exist legally, it cannot possess the competence to sign a contract. So those are our three primary knots: offer and acceptance, consideration money, plus truth and competence. When these three are tight, the transactional illusion fades and you have a sound, constitutional agreement. Now, concepts like consideration and counter-offers can feel a bit abstract when we just talk about definitions. So, to illustrate how these constitutional principles function in the real world, let me share a hypothetical scenario. While this story is created for educational purposes to demonstrate our S3 framework, it reflects common patterns we observe when families and business owners navigate the insurance acquisition process. Picture a fictional business owner named Marcus. Marcus runs a successful architectural firm. He's detailed, he's organized, and he cares deeply about his partners and his family. Marcus decides it's time to apply the SAFE principle to his business. He wants to buy a buy-sell life insurance policy on himself, so if something happens to him, his business partner has the cash to buy out Marcus's shares from his wife, Sarah. It's a classic, responsible move. Marcus applies for a $2 million policy. He does the medical exam in January. He writes a check for the first month's premium based on the quote the agent gave him. He's made the offer. Now, time goes by. Underwriting takes a while. It's now late February. In that window of time, between the application in January and the approval in February, Marcus visits his dermatologist. He has a small spot on his shoulder removed. It turns out to be a very early-stage melanoma. It's treated, Dr. Scones. We got it all. You're fine. Marcus breathes a sigh of relief and goes back to work. He doesn't think to mention this to the insurance company because, in his mind, the exam is already done. 2 weeks later, in March, the insurance policy is approved. The agent brings the policy to Marcus's office for delivery. Now here is where the knots come into play. The insurance company accepted Marcus's offer, but because time has passed, they require a statement of continued good health to be signed upon delivery. This is a standard document asking, has there been any change in your health, or have you seen a physician since the application date? Marcus is busy. He's looking at blueprints. He sees the form, thinks about how he feels great today, and thinks, well, the skin thing is resolved. He checks no changes, signs the form, and hands over the final check. Let's pause the story there and look at this through our SafeSimpleSound lens. Marcus believes he has tied the knot, he has the policy, he paid the money, but has he provided consideration? Remember, from our CFC background at SafeSimpleSound, we define consideration as money plus truth. Marcus provided the money, but he did not provide the truth regarding the visit to the dermatologist during the application window. 3 years later, let's imagine a hypothetical tragedy. Marcus passes away from something completely unrelated, perhaps a heart attack. His business partner files a claim for the $2 million to buy out Sarah. The insurance company reviews the records, as they do for all claims, and they see the dermatologist report dated after the application but before the policy delivery. They see the statement of good health, where Marcus checked no changes. Because the consideration, the truth, was incomplete at the moment the contract was finalized, the insurance company can legally argue that the contract was never validly formed. They could rescind the policy, refund the premiums, and deny the $2 million claim. Suddenly, Sarah and the business partner are left without the safety net they counted on. Not because the insurance company is evil, but because the constitutional knot of consideration wasn't tied. While this story is fictional, it demonstrates exactly why the safe component of our framework is so critical. From a safe, simple sound perspective, this isn't about scaring you. It's about empowering you to understand the rules of the game. If Marcus had understood that consideration included that doctor's visit, he would have disclosed it. Yes, it might have delayed the policy, it might have even changed the rating, but he would have had a valid contract, a sound contract. This example shows patterns we observe when families rush through the delivery phase of insurance. We treat the delivery meeting like signing for a UPS package, just a scribble on a pad. But constitutionally, that moment is the final tightening of the knot. Whether you are facing this exact situation or simply reviewing your own existing policies, the lesson is clear. Transparency is the currency of validity. When we apply S3 thinking, we welcome the scrutiny of the application process. We want the insurance company to know everything, because once they know everything and issue the policy anyway, they are on the hook. That is how we move from hoping to knowing. We've covered the mechanics of the contract: offer, acceptance, and consideration. We've looked at competence. Before we close, there is one final knot we need to touch on, which we call lawful purpose. This principle is fascinating because it distinguishes insurance from gambling. In the eyes of the law, a contract must have a lawful purpose to be enforceable. You cannot, for example, sign a contract to hire someone to rob a bank. That contract is void because the purpose is illegal. In insurance, this manifests as something called insurable interest. You cannot take a life insurance policy out on a stranger. You cannot insure a building you do not own. Why? Because if you could insure a stranger, you would have a financial incentive for their demise. That is against public policy. To have a sound constitutional contract, you must prove that you would suffer a financial loss if the insured event occurs. A wife has an insurable interest in her husband. A business has an insurable interest in a key executive. A bank has an insurable interest in a borrower. This usually gets sorted out during the application process, but we mention it because it often comes up in our practice during divorce or business dissolution. If you get divorced, does the insurable interest still exist? Usually, yes, if the policy was valid when it was issued. But these are the questions that a safe, simple sound review asks. We don't just look at the death benefit amount. We look at the relationship between the owner and the insured to ensure the lawful purpose knot is still holding tight. We have covered a fair amount of legal ground today. We've talked about the illusion of the transaction. We've broken down the knots of offer and acceptance, consideration, and competence. We've looked at the tragedy of untied knots through Marcus's hypothetical story. It can feel a bit heavy. Legal details often do. But let's bring this back to the safe and simple principles of our framework. Why do we share this? We don't share this to make you suspicious of your insurance agent or fearful of your policies. We share this because true financial peace of mind, the sound in safe, simple sound, comes from knowing your contracts are enforceable. It comes from knowing that when you pay that premium, you aren't just transferring money, you are securing a binding promise. When you verify these elements, you stop worrying about the fine print. You move from a place of anxiety to a place of authority over your own financial life. So, what should you do next? How do you apply this? We recommend a simple safety check of your current policies. You don't need a law degree to do this. You just need to look at your policy with fresh eyes. 1. Did you receive a counteroffer, a different rating when you bought the policy? If so, do you have the signed amendment accepting it? 2. Do you have a copy of the application attached to your policy? Scan it. Is it true? Was there a medical event between the signature and the delivery? 3. Are the owners listed on the policy competent legal adults or valid entities? This episode draws from our recent blog post titled, "Is Your Financial Safety Net Actually Tied?" You can find that post at SafeSimpleSound.com. But to make this even simpler for you through our S3 approach development, we've created a specific tool to help you audit these knots yourself. It's called the Safety Net Validity Checklist. It is a simple, one-page guide that walks you through verifying the offer, acceptance, and consideration of your current policies. It takes less than 15 minutes to use. If today's S3 insights resonate with your family's situation, or if you feel a little knot in your stomach realizing you aren't sure about your own coverage, we invite you to download that checklist. And of course, if you want a team to help you tie these knots, if you want to explore what constitutional financial planning looks like through our Safe Simple Sound practice, we are here to serve. But either way, whether you engage with our practice or simply use the checklist on your own, you are now equipped with a constitutional capability you didn't have 20 minutes ago. You know how to check the parachute before you jump. And that, friends, is how we stay safe, keep it simple, and ensure your future is sound. Thank you for listening. We'll catch you in the next episode.